of you online and those of you who don't know me, I'm Frank Congelos. I'm the managing partner here at CNA Financial Group. So on behalf of, our firm and all of our partners and so forth, we welcome you for, being here. We have an interesting program this morning. It's our favorite topic, which is, can we save some money on taxes? What can we do? And one of our subject matter experts, happens to be with us today, Ernie Guerrero. And it's interesting is when I looked at this slide and I thought I studied a lot. And then when I looked at how many initials he had after his name, I was like, holy cow. It's like, he's a really good student and he's a really smart guy. So you're gonna hear from him in a minute. But before that, I'm just gonna give you a top 10 because, as he goes through, cash balance plan, how to save money in retirement plans and things of that nature and how it impacts, those of you who are business owners with us today. There's also a few other things that you should be thinking about as we're getting into year end. So those of you who are, I'll say over 40-ish that may have remembered David Letterman, he'd have his top 10. Ever remember that? Some of you are sitting there going, who's David Letterman? But I'm just gonna give you, kind of a top 10 so that, as you may think about this, you can bring it back, whether you can bring it back to your accountant, you can follow up with us if you need more insight on this. For those of you who are accountants that are listening in online, this to be true, but just to give you perspective, here's just a few things that you should be thinking about right now, which is, as you're getting into year end, everybody should be meeting with their accountant and doing projections as to where they're at. As you're doing that, you're either gonna do one of two things. You're gonna, accelerate expenses, which is if I need more expenses this year, this is the time to do it. Okay, and you may also consider deferring some income. So if you have a really great year, at the moment, and you're like, I'm gonna get killed in taxes, and you have money that's coming due, sending out those billings January 1st and deferring some income, not a bad thing to do. And also accelerating some deductions. Under the big beautiful bill that came out, section 179 allows you to take accelerated depreciation. It's 100% right now. So those last year or 2 years ago, it was a year ago, I was getting a new car. And somebody said to me, Frank, if the car's over 6,000 pounds and it's used for business, you get this accelerated depreciation. And so last year was like 80% when I did it. This year it's up to 100%, it's back. So there are certain things that you can expense under section 179, automobile for business, and it's a fairly big deduction, just a food for thought. Next one, qualified plans. You're gonna hear more about that, just so that you know. A couple of other things. Research and development tax credits. Entity structures. Under the new tax law, how your entity is structured, you should have your accountant reviewing it to see if you may have an opportunity for, better tax savings. Tax loss harvesting, if you have investments that have a loss. Examples of where people have had losses, market's been up, but not every sector of the market. And the other thing that occurred was back in 2022, when interest rates went up considerably, those people who have bonds, those bonds are still underwater. So to repurchase or sell an existing bond and repurchase at the higher interest rate today is a good thing. And you get to offset those against your gains. So just be aware of it. And we'll go back to this. Deductible expenses on certain insurances, retirement plans, you're gonna hear more from Ernie. And estate planning, a couple of things there with regard to gift exclusions are pretty high right now. They're 19,000 per person for a couple of 38, and the exemption is 15 million. So very few people right now are gonna be subject to tax. And so those are just a few things offhand, we call them our top 10 to just be aware of. So having said that, I want to introduce our guest speaker. So many of our clients and many of you who are business owners have 401k plans. It's kind of becomes a standard in what business owners do. And the reason being is right now, labor is one of the key things that are out and retaining employees. But as business owners, what happens is that, as we put away money into, retirement plans, sometimes we like to get larger deductions. So Ernie Guerrero is a specialist in the area of business planning and retirement planning. And he's half kidding, but I'm really serious when I say is he's a smart guy and really does understand how to utilize and be very creative with retirement plans to maximize deductions for business owners. So it's my privilege and honor this morning to introduce Ernie Guerrero to you. And I'm going to hand it over to Ernie, and he's going to give you a deep dive on some of the things that are available and some of the things that you could do to reduce or eliminate some taxes that you have that may occur this year and going forward. So Ernie, with that, I'm going to turn it over to you.
Great, Frank. Frank, thank you very much for your kind words. I have between my wife and my 3 daughters, I actually know nothing, Frank. So that's why I have to stay in school. What I'm going to touch on is a couple of things for everybody. Frank had alluded to and before I get into this discussion of one of the strategies that we have, Frank alluded to the 179 bonus deduction under the big beautiful bill. We do a lot, and we see what's going on across the country. And the typical example, and Frank alluded to a car, but typically we get into the situation where the accountant, the CPA, is looking for deductions for the business owner and says, go out and buy another John Deere tractor. And we could write that off. We could get a big deduction. Well, that's all well and good. What I would suggest is let's consider other strategies, because what that does is now we have another piece of equipment that's sitting in the yard or the driveway that's depreciating. Whereas we may be able to accomplish the same goal of generating a tax deduction with an appreciating asset that's also doing double duty to help you with retirement. And that's really what we're all about is, one, let's see where you currently are, not only from a tax perspective, but also from a retirement perspective. And the real question is, how are you going to monetize? In other words, how are you going to take all these assets that we've accumulated, that you've accumulated throughout these years, and how are we going to turn that into income that we're going to live off of, hopefully for the rest of our lives? And possibly, if you're inclined, how are we going to also leave a legacy after we're gone? So we want to help you through that whole entire stage. What we're going to go over this morning is simply how did we get here? What's available, but more importantly is how do I take advantage of this? And cash balance plans have been around for a while, but they're really not mass marketed. Frank had alluded to the profit sharing 401k, the SEPs that are out there, maybe a simple IRA. They're good. They're a good place to start. But what we've found is that just as your business has a life cycle, so do retirement plans. So SEPs and simples are really good when you're starting out, but at one point in time, you're going to outgrow them. And if you look at what's going on in the legislative front in Congress and all these laws that have come out, it's really to say, Mr. and Mrs. Employer, you're really at the heart, you're at the ground floor. We want to make it as easy as possible for you to actually establish a plan, not only for yourself, but also for your employees. And as you're going to see as we go through this, and my experience in working with business owners all over the country is what's in it for me? In other words, if I'm going to go through the expense and the time of offering a plan, how do I get the biggest bang out of it? And I'm going to share a case study with you as well. We also work with a lot of accountants and CPAs around the country, and their goal a lot of times is business owners are going to them to say, how do I reduce my taxes? Now, if you're in that rare position where you want to increase the taxes that you pay, I don't know, Frank, maybe we should ask them to leave at this point, because this is not going to help them. And I haven't met too many business owners that say, Ernie, you're absolutely nuts. I want to pay more taxes. It's just the reverse. And working with Frank and his team, what they'll do is they'll take you through a process to understand the taxes, but also work with you on what's called tax buckets. I mentioned getting you to monetize your assets at retirement, but how do I do that in the most tax efficient manner? By building different buckets of taxable and non-taxable or tax-free assets that I can access later on in life. For the small, closely held business owner, and I hate to use that word small, I'll just say the closely held business owner, your income, the revenue, the emotion is really intertwined between your business and your personal life. There isn't the big distinction between a corporation, a publicly traded corporation, where the CFO, the CEO at night shuts the door and they go home and they have their personal financials and their personal lives. This closely held business owner, that's all intertwined, and we understand that. So when we're planning for you, and we're planning on the personal level or on the business level, we need to make sure we're looking at a holistic approach and that we're as efficient as possible. Other advisors and vendors, they may approach you on this, but what we've seen is that either plans are not coordinated or the plan is actually done incorrectly where the IRS may question its design. We operate in a very conservative fashion, making sure that not only are we within the rules, but also we're in that box that we're also within the spirit of what the IRS wants to accomplish. This also helps you to increase your retention. Frank mentioned, about employees. Well, how do we retain and attract quality employees? These types of plans allow you to become the employer of choice. If I'm going to go to work for Frank's organization, or I'm going to considering working for your organization, in addition to the salary, those hard dollars that I'm getting, I want to look at the overall package. And this is part of it. It becomes part of the overall compensation strategy. No disrespect to any CPAs or accountants out there, but I pulled this right from the Journal of Accountancy, January 1st, 2023. Now, this is within your own industry that said most CPAs and their business clients are familiar with the popular company retirement plans. Again, I mentioned the SEPs, the simples. When it comes to these types of plans, cash balance plans, traditional plans, fully insured plans, there's a lot of misnomers out there. There's a lot of noise out there that really stems from the media or people who just don't understand how they operate. How can we make this as beneficial for you, the business owner, as possible? Under the Secure Act, and this is where Congress has allowed us to make it easier for business owners to start these plans. They've offered tax credits, meaning a non-refundable income tax credit. And as everybody that is listening in, a credit is more valuable than a tax deduction because it's a dollar for dollar reduction in your tax liability. The tax credit is up to $5,000. And in addition, there's also tax credits for the contribution. So the plan, even though we have to go to a third-party administrator, may not cost anything because of these deductions and credits. In addition to that federal tax reduction, we're also looking at reducing the corporate taxes against business income. Also, depending on how you're structured, a pass-through, we're also saving on personal federal taxes. And they're the top marginal bracket, the income. This was in 2023. We've updated it for 2026. You can see it's, even though it's high, business owner income has also risen. And let's not forget state taxes. I know you're in New Jersey. I'm in New York. The tax rate is pretty high in these states. We work with people in California where it's very similar to what we're paying. And it's a tough bite. The personal investment tax, the extra 3.8% that you're paying in individual earnings over 200,000 or 250,000. Well, if I could reduce that income by putting money into your pocket, basically taking it out of your business on a tax deductible way and putting into your personal pocket and reduce your income under these levels, well, we could save money there as well. Well, what about the Medicare tax, that extra 0.9% in tax? And the other thing is the qualified business income deduction. And I know the CPAs and accountants on this call are very familiar with this. One of the roles of a cash balance plan would be to keep your income under these levels so that you would qualify for this deduction, that 20% deduction that you could take. So you could see by considering a cash balance plan, it wears many hats in addition to putting money away for you for retirement. You could see the limits here. If you're 55, 60, or 65, looking at normal retirement ages, and the reason why we go to 70 here and 65 is because you need at least 5 years in the plan. You could see the contribution amounts are much higher than you could get in a SEP, a simple, or a profit sharing 401k. You can see here the $359, $389, $489,000 deduction. The profit sharing plan will allow you to take a $31,000 deduction maximum, assuming you're over age 55. That's the deferral. The maximum that you could put into the profit sharing 401k is $72,000 in 2026. Now remember, for those of you looking at a deduction for 2025, you would actually have until you file your tax return in 2026 for the 2025 calendar year to actually implement these kind of strategies. So we're looking at total deductions here of over $350,000. Now again, keep in mind, please, to reference this, this is the maximum that you could put in. We could always dial this down. So I'm showing the maximum that could be put away. So let's look how this impacts a 55-year-old that currently has a SEP plan or a simple plan. I'm sorry, a SEP or a profit sharing plan. We're looking at total taxable income of $600,000. They currently have a SEP. They currently have a They currently have a profit sharing plan. Robots are starting to take over here. The maximum they could put in 2025 is $70,000. So that reduces their net income to $530,000. Someone in a 40% tax bracket, they're paying $212,000 in tax. Pretty simple calculation for illustration purposes. We have that same $600,000 of taxable income. We now add the cash balance plan, getting a deduction of $390,439. That leaves our net income at $209,561, reducing our taxes from 40% to 25%. Now we're paying $52,390, saving $159,610. Now, you're probably thinking, well, that's great, Ernie. How do I live? Making this big deduction. Well, we're also assuming in our experience is that what's reported as compensation on the tax return, there's a lot of leeway there. So this usually works for those companies that are, if you're very profitable and if you have a good outlook for the future. The impact on the Section 71, the 199 deduction. If you're a pass-through, let's look at the same example. You have $600,000 of income. You currently maintain or you're considering a profit-sharing 401k plan or a SEP. Well, the maximum deduction there is $70,000. I now add that cash balance plan of $390,439. My qualified business income on the profit sharing SEP side is only reduced to $530,000. If I use the cash balance plan, I have reduced my business income to $209,561. Because I'm over the threshold for the 199A deduction, I do not get to take that. By using the cash balance plan, I now get to deduct the additional 20% because I dropped below the threshold to take advantage of the 199A deduction. My net income on the SEP profit sharing plan remains $530,000. However, because I took the deduction, it reduced my income to $209,561. I take my 20%, which is the $41,912. That further reduces my income to $167,694. The tax I owed is also reduced. Remember, I was paying 51, reduced it down to 41,000. So now I have a tax savings of $170,088. I just found you $170,000 basically, plus I put $390,000 into your pocket. It's not magic. This is on the books. This is how these plans work. I want to stop there for a minute, Frank, and just see if anybody, what they're thinking is any questions on this at this point, or anybody on the call.
So Ernie, I'll start with a couple, unless anybody chimes in. So one is just to reiterate, in doing this, you're showing the max they can do. If somebody said, hey, we've got 100,000 in capital or 200,000 in capital, we can set aside. They don't have to go to 390, they could set aside 200.
Exactly, Frank. What I mentioned, we're starting with the ceiling for illustration purposes, but if you say, yeah, I like this, but I'm comfortable putting in 200,000, what would that look like? We could illustrate that impact on the right side of this sheet. If you go too low, remember here, this is the limit on the profit sharing 401k plan. So we want to definitely get above this, Frank, and that's the goal. And usually we will massage the numbers working closely with the business owner's other professional trusted advisors, like their accountant or CPA, to come to that happy meeting, because we also are very sensitive to cash flow. And we want to make sure the client has enough cash flow to sustain this.
Very good. Any other questions, anybody?
Okay. Well, what is a cash balance plan? You've heard a lot of talk about it. A cash balance plan is actually a hybrid type of plan. It's a cross between a profit sharing plan and a traditional defined benefit plan. And the reason why we say it's a hybrid is because it's subject to all of the rules of a defined benefit plan, specifically what's called the minimum funding rules, meaning the contributions are not discretionary. But it looks like a profit sharing plan. For those of you that have profit sharing 401k plans, one of the characteristics of those plans is you get to see the values basically on a daily basis. Well, that somehow mirrors also what the cash balance plan looks like. For those of you that have been covered by traditional defined benefit plans, that's a little more convoluted. You can't see really your daily balance unless you speak with the plan's administrator and actuary to get that calculation. So the traditional plan, the cash balance plan, is more fluid. It's more transparent. So employers like it because they could see what their balance is, and employees like it for the same reason. Some of the differences: the profit sharing 401k plan is directed by the employee or the employer. So you're directing the investments. You're responsible for the investment outcome. The contributions are flexible. You could go anywhere from 0 to a maximum of 25% of your compensation. So it's capped. And these are individual accounts. On the cash balance side, it's trustee directed. So either you, as the employer, as the plan trustee, get to direct where the investments are going to be, unless you decide to outsource that function. And I'm going to talk about that later. The cash balance plan is all employer contributions. There are no employee contributions here. So in many cases, what we're doing is, if you do have an existing profit sharing 401k plan, we're layering this, or we're putting this cash balance plan on top of that profit sharing 401k plan, and we're combining the two. It's a pooled investment, meaning there's one investment account that's being controlled by the plan trustee. Minimum funding requirements. What that means is contributions, once we set them, are mandatory, meaning you have to make them. Now, in reality, what's going to happen is the plan actuary is going to calculate a range, and they're going to give you a minimum, a target, and a maximum. And it's up to you to decide how much you want to put in based on your company's cash flow. I do caution employers that be careful when you're putting in down to the minimum and you're doing that consistently, because what could happen, and I want to do a little sidebar here and give you a little history. You all are aware of the problems, I guess, that I'm going to call it a problem, that are occurring in the traditional defined benefit market. Your schools, your local towns, municipalities, they have traditional defined benefit plans. And what happened in those plans, and why they're in trouble today, is because back in the 80s, when interest rates, when the stock market was really going through the roof, they were putting in the minimum because they were getting very high returns. Well, what happened then over time is the market started going down. Now, in a traditional plan, traditional defined benefit plan, they tend to get more expensive over time as the population ages, as the demographics age, and as compensation increases. So the effect of putting in low contributions, coupled with the fact of you're mandated to make higher contributions, that's why these traditional plans are blowing up today. The beauty of the cash balance plan, it tends to levelize your contributions over time. The IRS also gives some leeway in that minimum funding requirement in terminating the plan or amending the plan within a short period of time, but it must be done for a reasonable business justification. Meaning the IRS says you can't make if you can't make your contribution, you have to justify why. Well, death is a reason not to make the contribution, disability, loss of a partner, loss of a key account, downturn in the economy. Well, if the IRS does flag it for a permanency issue, those would more than likely be reasonable business justifications. However, the IRS would question if you didn't make the contribution, but yet Frank, as the business owner, says, well, hey, I can't pay the contribution because my country club just assessed me $200,000 to repair the pro shop. I don't think the IRS is going to go along with that. So these contributions are sort of set once we determine what that level is. And in some cases, they are insured. They are subject to the PBGC coverage if you generally have more than 25 employees and are not a service business. Well, what do they look like? How do they work? As we know, profit sharing 401k plans are subject to the employee making contributions and investment earnings over time. With the cash balance plan, it's a little different. Employer makes the contributions, and the plan determines the interest credits that are going to be given over time. Generally in the cash balance plan, the interest that we're going to credit the overall portfolio with is 5%. So either you as the plan trustee or working with Frank and his team, or if that's going to be outsourced through Frank and his team to a professional money manager, the bogey they want to hit each and every year is 5%. So they'll design their portfolio to hit that bogey of 5%. And if all goes well, when you hit normal retirement age, the money that was promised in the plan will be there. Unlike the profit sharing 401k plan, if markets go down when you're ready to retire, well, there's going to be a big loss, or you're going to have to keep working. This is what I like this visual, because the importance of hitting that target of 5%. If we get too much of a return, well, that's going to lower our contribution. And we may be faced with a fact where we're overfunding this plan. And that's not good, because if you come to a point where you want to terminate this plan, you're going to retire, you're going to sell the business, and there's an overfunding in the plan, the IRS says that cannot revert back to you. There's a 50% excise tax on any overfunding that's in the plan. So you could see the importance of making sure we're within that range of 5%. If we get too low of a return, well, the actuary is going to have to come to you and say, hey, Mr. or Mrs. Employer, you're going to need to put in greater contributions to make up for that shortfall. And a lot of times we didn't budget for that. That could be a hardship on the business to put in too much. I want to sidetrack here just to show you some of the things that we go through. We have a case now where we're working with one of Frank's counterparts in another part of the country, where his client, about 20 years, came to the advisor with an issue. The issue was they were $20 million overfunded. And we're trying to correct that. How do we alleviate that 50% penalty on the $10 million? So why we're very, very sensitive to making sure we want to keep that 5% and hit that 5%. Let's look at a case study. Here we have a pretty standard case of kind of the cases that we get here. I try to change the names to protect the innocent. And I don't know, I thought, gee, let's use fruit. So that's why you see we have Brenda Grape and Paul Cherry as the owners and the highly compensated individuals. And we have their employees, their dates of birth, dates of hire, their present age, and their retirement age, and their annual compensation. This happened to be a corporation where Brenda and Paul were 50-50 owners. Now, I want to also disclaim this fully. As a pass-through entity, it was a C Corp. Brenda and Paul were taking W-2 of $200,000. They had a lot more that they were passing through. So their financial standard of living was very well. The business was doing well, and they had no problem with cash flow. Here's what we designed. We designed a cash balance plan and a profit sharing plan where we had the employer contributions going into the cash balance plan. You can see here. There was a non-elective, meaning we had an employer contribution going in to offset the contribution that was going into the cash balance. Now, why we design it this way is because that allows us to put lower amounts for the employees and greater amounts to the owners. Now, you can look at this and say, well, gee, Ernie, this looks kind of discriminatory to me. Well, the IRS does give us leeway on how we design these plans. So this does pass the non-discrimination testing. And you can see here the total contribution. Now, you'll notice a life premium. We do use life insurance in the cash balance plan. And the reason is, from a money management perspective, there's an inherent guarantee that's in the cash balance plan, that's in the life insurance. Remember I mentioned that 5% rate of return? Well, by using life insurance, that allows us a cushion of 3%, which is the guarantee in the life insurance contract, depending on who you're dealing with. Guardian does have products for this marketplace. So we use it from an investment perspective, not only to balance the portfolio, but also as an alternative investment. And I'm sure everybody out there has heard of alternative investments. You've probably heard of private equity, of opportunity zones, of crypto. Well, adding life insurance is another alternative investment in this portfolio. Well, what does it look like on an after-tax basis? I want to go back here. Here's your total contribution, $479,291. I'm in a 40% tax bracket. There's my tax savings. I'm saving $191,716. So my net after-tax cost is $287,575. Now, keep in mind, I'm putting $303,000 back into the owner's pockets. That's the addition. I'm adding Brenda and Paul's contributions. So I'm taking $479,000 out of the business on a tax-deductible basis, and I'm putting $303,000 back into Brenda and Paul's pocket. Therefore, if it's only costing me on a net after-tax basis $287,575, but yet I'm putting back into your pocket $303,572, do I have any cost here on a net after-tax basis? And Frank, I'm just going to pause for a minute there. Just let that sink in. Does everybody agree with this? Does this make sense?
Any questions, anybody?
Okay.
Where's the coffee?
Right there.
Hey, you have bigger problems there in New Jersey than I do up here, buddy. Now let's take a look at the life insurance, because we do get questions about this. Brenda and Paul also needed life insurance, and I want to state this up front. Life insurance as an asset class is appropriate. As an alternative investment, it's appropriate in these plans. But what about personally? If there's a life insurance need, if you determine you need more life insurance, whether it's to cover your family, your financial security, whether it's to cover your business, it makes sense to use it in the plan on a tax deductible basis. There's no other area in the tax code, at least, where you could take a deduction for life insurance. Frank, you've been around a little longer than I have. Have you come across any other situations where you could tax deduct life insurance?
No, and I'll tell you a funny one, which was I had a very successful client of mine send me something recently that they somehow found. And they were like, Frank, have you ever heard of this? It's a way that you can put, insurance in an entity. And I sent it up to our tax specialist, Jim Magner.
Yep.
And he was like, Frank, he goes, we kicked this out. We wouldn't allow our advisors to do it almost 20 years ago. We'll never allow it. This thing has been overturned 10 times. But there's still people out there pushing things that, are like really marginal versus, where it's straight up, legal to do and appropriate. So.
Thank you, Frank. Yes, the IRS does allow it, providing it must be incidental to the overall purpose of the retirement plan, which is to provide retirement benefits. So we are within that incidental benefit rule. So here, we purchased Paul and Deborah $2.7 million of coverage. If they should pass while still employed, the carrier, in this case Guardian, would pay $2.7 million to the plan, and Deborah and Paul would name naturally their beneficiaries to get not only the life insurance benefit, but also their accumulated balance from the cash balance plan. Now, what's the true cost of putting the life insurance inside the plan? Well, the premium for Deborah and Paul at their ages, it would cost a premium of $42,400. The income that they would need on an after-tax basis with a personal check, they would have to earn $70,776 being in a 40% tax bracket. So they would have to earn that to pay the $42,400. Inside the plan, because it's tax deductible, it's only costing $25,440. The premium cost over the 10 years, and this is simple multiplication, the 25,440 over 10 years is $254,400. However, what they had to earn over those same 10 years is $706,667. Now, there is a tax cost in the plan. There's a economic benefit, which represents the 1-year term cost. Remember, I mentioned the IRS says the retirement benefit is for the future. However, you're getting an immediate benefit in that life insurance if you should pass the day after you start this plan. Therefore, that over 10 years, the reportable benefit is $13,000. Outside the plan, the tax cost, the extra amount that you had to earn is $282,667. The tax savings inside the plan, $169,006. That's what you saved by taking that deduction over those 10 years. And there's no tax savings naturally on an after-tax basis. The guaranteed cash value. Now, I am not even loading this up, and there's strategies that Frank and his team can talk to you about as far as how to increase that cash value. I'm not doing that. I'm only looking at the contract guarantee at normal retirement age. So over the 10 years is $340,239, and that's going to be the same inside the plan or outside the plan. Now, I have to take the life insurance out of the plan at some point in time. So let's say I take a taxable distribution, and I'm going to now have a reportable tax of $340,239. When I do my tax return, I'm going to have to declare this as income, this $340,000 as income. So therefore, that extra tax is going to equate to $136,096. Naturally, outside the plan, I don't incur any tax. However, one strategy is that I could take a loan from the plan, from my life insurance policy, and I could borrow that $136,096. And that's going to leave me $204,143. So what did I do? I had a tax deduction. I used the tax law. I used Congress to save taxes over the 10 years. I now take the life insurance policy out of the plan, and I have a reportable benefit. However, it's not costing me anything because I could take money out of my life insurance policy on a tax-free basis to offset any tax that I have due. Here, my net after tax after the distribution is simply that guaranteed value, right? Because I'm not paying any tax. However, if I factor back in my tax savings minus my tax cost here, I'm still netting $360,743. Over here outside the plan, because I had to earn more dollars over time to pay the premium, it's actually costing me $57,572. So here in this situation, by having that alternative investment life insurance inside the plan, not only helped me hit my target investment return, it also provided for a pre-retirement survivor benefit for my loved ones. And it also allowed me to carry that policy outside the plan to provide a legacy. Now let's look at the premium. It works the same way. Remember, I was paying the plan, or you paid $42,440 over the 10 years, total $440,000. The tax cost, that was that tax cost from the beginning, and my tax cost outside the plan because I had to earn more, the same tax savings, the same net after tax after the distribution. So even on the premium that I paid, factoring in the taxes and the tax savings, it cost me $63,257 for this policy. Outside the plan, it cost me $366,428. Now, Frank, and you're a team, because I know you guys are experts in the products and using this, a $2.2 million permanent whole life insurance for a 10-year cost of $63,257. Is that a pretty good deal or what?
Yes.
And let me pose this question to the audience. Would you rather pay $63,000 or $366,000 for a product? It's buying it wholesale versus retail. Next steps, and I'm in closing here. This is an ERISA plan, subject to ERISA, which means that as an employer, if you are going to incorporate or establish any type of plan, profit sharing 401k or cash balance, you are a plan fiduciary. And that simply means, not simply, but it means that you are personally responsible for the operation of that plan. So what I would request of you, if you're going to go down this road, speak to the experts there, speak to Frank and his team to make sure that the T's are crossed and the I's are dotted, and that you're dealing with other vendors that know this market, so that not only are your employees protected, but that you are protected as much as possible. Know the client, which means know your demographics. Is this plan appropriate? Set the right expectations. What am I going to expect from this plan? How's it going to operate? Understanding how those interest credit works. In the cash balance plan, you're promising a benefit, but the benefit is based on what's called pay credits and interest credits. So if I'm making $100,000 a year and you're promising me a pay credit of 3%, well, I know I'm going to get $3,000. And if that $3,000, my pay credit, I'm going to be granted a 5% interest credit, well, I do simple math. I know my $3,000 is going to grow at 3%. So the math is pretty simple, and you can see the beauty of the cash balance plans. Also, we'll help with the investment policy statement to keep us guide us in the investments that we choose. Construct that portfolio. Now, we also recommend we work with professional money managers that do this, so they understand how cash balance plans work. And we need to work with you and monitor this plan on either a semi-annual basis or on an annual basis. Some things to avoid. There's a lot of things that we as professionals working with you need to know. There's control group issues. Many business owners don't just own one business. You may have multiple businesses. Well, if there's a control, if you own a majority, or if you have partners, or maybe your spouse, significant other, well, we need to look at all that, because if it is determined to be a control group, all of those business entities within that control, within your control, are treated as one. Also, prohibited transactions. You cannot self-deal with this plan. I had a case one time. The gentleman was out of Long Island. He had a successful. What he did is he bought and sold rare cases of wine, Any wine drinkers out there? I know it's early, but anybody drink wine? I know I do. Anyway, yeah, I was impressed. He had about a 20-30% return. What he would do, he would locate these rare wines, and he would trade them, he would hold them, he would sell them. He was making a good return on that. And he approached me, says, "Hey, Ernie, can we put my wine in my plan?" And I said, well, sure. Wine could be an investment in this plan if it's prudent, if you as the trustee feel it's prudent. I said, however, do you ever drink any of this wine that you're dealing with? And he looked at me and says, yes, are you crazy? It's really good wine. Do you want some? No, I couldn't take that. It would be considered a bribe because it was clearly over my $25 limit. And I said, well, that's self-dealing. If you drink any of the wine that's in this plan, you're self-dealing with the plan, and the IRS could disqualify it. We get self-dealing in situations where there's property in the plan. We have larger plans where the owners have a strip mall, and they put the strip mall or they put condominiums in the plan. Well, if you use them, it could be a prohibited transaction. Another situation, an individual had a condominium down in Myrtle Beach, South Carolina. And, we were doing our fact finding and found out that all his family, his nephews, nieces, grandchildren, used the condo. Well, that's self-dealing. So we need to know exactly, we need to know all facts. Your fiduciary obligations as a plan trustee, you need to know them. You have to be aware of early termination. I mentioned that scenario, Frank paying his country club rather than paying the plan. Well, if you shut these plans down early without a reasonable business justification, well, that could set up a red flag with the IRS. I mentioned the underfunding and overfunding, that situation that we're in now where it was $20 million overfunded. Well, we need to make sure that we're always within this range. And there is reporting. The plan files a tax return. The plan files a Form 5500 that we have to make sure is accurate. So the other professional partners that we have would help us through all this. We have to look at non-discrimination testing. We can't just set up a plan for the owners, their spouses, and children. We have to include, or we have to consider, all employees that are working for you, as well as coverage, participation, top heavy, and again, a strategy where we're looking at an absolute return. So we have to wear a different hat. We're not chasing returns here. We're simply trying to hit our bogey so that we get our deduction and we get the promised benefit at normal retirement age. Identify, is this appropriate for you? Is this something that you may consider appropriate? Ideal candidates. Well, who'd be appropriate for this? Well, if you're a business owner and you're a business owner and you're 50 or older, again, I apologize, I'm trying to get back here. This may be appropriate for you. If you want large tax deductions, again, this may be something to look at. And you have steady profits, a solid future outlook, and you currently have a simple, a SEP, or a profit-sharing 401k plan. I'm sorry, that keeps popping up. Then again, this also may be appropriate for you. Frank, with that, I will close, and my goal, I hope, was to give the business owners out there an idea of there may be another alternative. There may be something where you could generate high deductions. There may be something that you could play catch up with your retirement income. It may be a solution to generate higher deductions. And it also is a way to diversify away from your business. How to take money out of your business on a tax deductible basis and on a real conservative level. Frank, thank you very much, Frank.
No, thank you. And so for those of you who are here with us, those of you who are online, just a couple of perspectives, which is, you know, if you think of it, there's obviously many tools and strategies in order to help you get what you're looking to get, you know, so if you're looking for tax deductions, you're looking to save for retirement. Whatever the case might be, our objective is to really help you to achieve whatever it is that you're looking to do. The reality is, and many of you have heard me say over the years, you know, always remember, every financial decision that we're all making is being made at different times with different people under different circumstances. And so our ability, you're seeing a financial group to really take that, you know, I call it, you know, macro manager view of somebody's overall financial world. Identify what's appropriate through, you know, I call it, you know, that virtual family office, and really sharing with people. Where are you at? What's important to you? What are you trying to accomplish? What's meaningful to you and your family? And then to just have you understand that this is one tool that may be appropriate for you. But, you know, it's like later today, hopefully I'm playing golf. This is one club in the bag. There's a variety of clubs in the bag, depending upon what your circumstances are. So depending upon your circumstances, our objective is really to represent you as that macro manager, to look at that total picture and to identify, you know, how do we help you to get what you really want? And I always say is what people really want is this. They want more wealth in terms of cash flow and quality of life. They want their assets better protected. They don't necessarily want to take more risk, and nobody wants to give up lifestyle. So if we could show people how to not give up lifestyle, have more wealth, don't have to take additional risks. And by the way, for us to take somebody through the process to see how we can help, it costs nothing. It's our way of getting to know you and giving you an opportunity to know us. That's what we're here for. That's what this is about. And again, this is one of our subject matter experts. So for all of you who are here with us today on a Friday morning, happens to be a pretty nice Friday morning. Thanks for being here. I wish you a great weekend. Ernie, thank you for your expertise, and what you do have a lot of initials after there. I never paid attention to that. I'm glad you're on our side.
Yeah.
So for Ernie, thank you, and Adina for putting it together along with Elena, and everybody have a wonderful weekend. We appreciate, you know, your relationship. We appreciate you, and if we can help you, we look forward to it going forward. So thank you and have a great day.
Thank you.